one.
Hello and welcome. My name is Barry Belli, and today I'm going to be talking about risk and return. Today's case is the Peachtree Securities Incorporation. What is the T-bond? Why is the T-bond independent of the state of economy? Is a one-year T-bond risk-free? Now, as given table 1, we can see the T-bond is 8% no matter the state of economy, whether it be a recession, below average, average, above average, or a boom. T-bond will always return at par value, no matter the state of economy. If the government is having trouble paying back bonds, Federal Reserve will step in. At T-bond return in an economy that experiences inflation, there will be less of a value, so there is risk with the T-bond and inflation. All investments carry a risk and an opportunity cost. Expected returns. To calculate the expected returns for each stock, we multiply the percentage of probability with that recession type. So for example, the T-bond expected return is 8%. See how there's no guarantee that the recession or below average will determine the different T-bond, so it's going to be 8%. Here we have the expected return of the S&P 500, which is the highest at 15%. Standard deviation and coefficient of variance. To calculate the standard deviation, we would multiply To calculate the standard deviation, you would first take the difference from the expected return and the stock, and then add those all together to find the standard deviation. Standard deviation here for the S&P 500 fund is 16.43%. This is a very high percent, and it shows that it has very risky. The less risky is the T-bond at 0%. As stated, there is no risk. The coefficient of variance would be dividing the standard deviation by the expected rate of return. Here we have a 0 coefficient of variance for T-bond, which means it is 0 risk. S&P 500 fund is the most risky with a 1.1 coefficient of variance. The best measure here is the coefficient of variance. Suppose an investor forms a stock portfolio by investing $10,000 in Gold Hill and $10,000 in Teco. To find out how much the portfolio weighs, we would multiply 50% by each investment, because you're investing $10,000 in each investment. The expected return is a weighted average. We want to reduce the risk of our investments, so investing in one stock would be more risky than investing in two stocks. As we can tell here, we have done calculations in 50% each, 75% Gold Hill, and 75% Teco. We can see that the best investment is investing 50% in each. Now, considering a portfolio consisting of 10% in Teco and 10% in the S&P 500 fund, we want to get a smaller standard deviation and also smaller coefficient of variance. This shows that it is less risky. These stocks on their own have higher standard of deviations and higher coefficients of variances. So the lower percentage here in this portfolio is a great sign. Suppose an investor starts with a portfolio consisting of one randomly selected stock. More stocks you add, the less riskier this portfolio will be, because the standard deviation will decrease. Is risk going to equal 0? Risk will never equal 0, because you can never eliminate all risk. In investments, there will always be some sort of risk. Why do we eliminate this risk? We eliminate our risk because a portfolio always contains risk, but the less risk you have, the more profitable you will become at the end. Calculating beta. To calculate beta, we use the CAPM model. Beta in this situation, when comparing it to the market, will have a perfect diagonal line. Here we can see that the beta of Gold Hill, Teco, and the T-bond do not have a perfectly diagonal line, so we have no beta of 1. The T-bond is a perfect horizontal line, which shows a beta of 0. Teco has a beta of 0.7, and Gold Hill has a beta of -0.3. Teco's stock using value lines beta estimate of 0.6. So now we calculated using beta of 0.6. The required rate of return after using CAPM came to 12.2%, which is lower than the effective rate of return. When the required rate of return is lower than the effective rate of return, it's considered undervalued, which means this is a good buy. How does the required rate of return change? Now, using CAPM, we have a couple different models here. From raising beta from 0.6 to 1, a 7% to 8% market risk premium, and also if TECO raises 3% inflation. Now, for the first example, if beta rose from 0.6 to 1, we would have a 15% CAPM, which is a required rate of return. This is the same as the market effective return. If the market risk premium were to go to 7 to 8%, which means that we would have an effective rate of return of 7%, the required rate of return would be 11.8%. And if TECO raises 3% inflation, then the required rate of return would be 13.4%. This is the models here. Suppose the debt to equity ratio was projected to decrease in 1993 and beyond. What impact would this have on TECO's riskiness, hence on its beta and required rate of return on equity? When we have a decrease in the debt to equity ratio, we become less risky with less debt. Beta will decrease, and if beta will decrease, the required rate of return will decrease using CAPM model. If beta decreases, your required rate of return will be positively correlated, which means it will also decrease, and vice versa. Thank you.